Let us see the next question. A doctor is considering purchasing of a machinery at a cost of 1,20,000. The project life of the machinery is 5 years and has an expected salvage value of 10,000 at the end of 5 years. The annual operating cost of the machinery is rupees 2,000. It is expected to generate a revenue of rupees 60,000 per annum per year for 5 years. At present, the doctor is outsourcing his work related to the machinery and earns a commission income of rupees 15,000 per annum. Net of taxes. Income tax rate is only 30%. You are required to find whether it would be profitable for the doctor to purchase a machinery ? Give your advice based on NPV method, based on PI method. Discounting factors have been provided at the rate of 9%. Kindly use your calculator. 0.917 plus 0.842 plus 0.772 plus 0.708 plus 0.65. When I make total of this, then in that case the total comes to 3.889. However, the total which they have provided to us in the example is 3.88. It is a question which was asked in examination by the institute, and so this kind of mistake may happen in examination. So just be careful. That's preferably I would say that let us go with the individual factors rather than going with the annuity factor which they have provided to us. So of course in the first part of the question we will make the computation of the NPV. I request all of you to make the calculation of the first 4 answers on your own, and please post your answer of the recurring cash flow in the chat box. So let us have a discussion. That's how to make calculation of answer. Dear students, over here we are required to take the decision from doctor point of view that whether to buy a machinery or not. Year 0, there is a cash outflow of 1,20,000. That is year 0 cash outflow, that is investment. Step number 2 would be depreciation. In that way we understand that 1,20,000 minus 10,000. So it is 1,10,000 upon 5. So there is an annual depreciation of 22,000 rupees. That is the way step number 2 depreciation will be there. Third step will be the terminal cash flow. In that step we will compute the capital gain or loss if it is there, and then we will consider the salvage value of the machinery as cash inflow. Step number 4 is the recurring cash flow, and that is what I think is the most important point of this question. So please start writing an answer along with me. Heading is NPV calculation. In that, step number 1, investment. It is an amount of rupees 1,20,000. That is in the year 0. Step number 2, depreciation. Again friends, no clarification is made regarding the method of depreciation. In this case we have to assume SLM. Cost minus scrap value divided by number of years. Cost is 1,20,000. Scrap value is 10,000 divided by 5 years. So 120 minus 10, that is 1,10,000 upon 5, that is 22,000 rupees per year. That is the step number 2, depreciation. Step number 3, terminal cash flow. In that, working note number 1, calculation of capital gain or loss on sale of machinery. Scrap value of machinery 10,000 minus written down value 1,20,000 minus 22,000 rupees for 5 years. So in that case the WDV is again 10,000. So capital gain or loss on sale of machinery is 0. Then we will have the recurring cash flow. As far as the recurring cash flow is concerned, in that sale value of machinery that is 10,000. If at all there is any working capital, it would be recovered, but no working capital is here. Capital gain or loss tax effect is again 0. So the amount of the terminal cash flow is 10,000. And of course, so this amount of the terminal cash flow is going to be received at the end of the 5th year. I'm sorry, I mentioned wrongly recurring. It is the terminal cash flow which will be received year 5 end. Step number 4, calculation of recurring cash flow. Now everybody is requested to stop writing. Let me explain to you. The question is providing the information that say it is going to generate the revenue of 60,000 rupees per year. So as usual we are doing it only for first year. Do not write anything, let me explain you. There is a revenue of 60,000 rupees. Then there is an operating expenses. It is an amount of rupees 2,000 rupees per year. Next is depreciation. The amount of the depreciation is 22,000 rupees per year. Okay. Now friends, over here, as far as this example is concerned, what I will do working like this. Profit before taxes. 60,000 minus 2,000 minus 22,000. So it is 36,000. Income tax rate is 30%. So profit after taxes is 70%. That comes to 25,200. Then depreciation is added back. Why? Because it is a non-cash item. That is 22,000. Less commission income. The language of the question is providing the information like this. For example, the machinery is say for the purpose of, let us say, some like blood test. So right now what doctor is doing, right now doctor is say referring the patient to a pathology laboratory. Right now the doctor is say referring patient to some pathology laboratory, and that pathology laboratory is giving commission to the doctor. What amount of the commission income doctor is receiving? The amount of the commission income is rupees 15,000 per annum, and this is the most important line of the question, net of the taxes. That is the reason say we are required to mention it as say the cash outflow after income tax, in a way that say after the making income post tax, this opportunity cost will be returned. So 25,200 plus 22,000 minus 15,000, that comes to 32,200. This is the way we will have the recurring cash flow. Of course, whatever the recurring cash flow for the first year itself is for the remaining years. If at all we would not have been given this information about the net after taxes, suppose it would not have been given, then in that case, friends, this opportunity cost is required to be considered as pre-tax. So we will mention over here commission income, an amount of 15,000, and so on. Calculation will be made. So it is 60,000 minus 2,000 minus 22,000 minus 15,000. So in that case it is 21,000 into 0.7, that is 14,700. Then you add back depreciation 22,000, that is 36,700. This is the way you would have made the calculation of answer. If at all that word net of the taxes would not have been given, you have to understand that when it is provided net of the tax, it means that the tax effect on the same has already been taken into account. So this is the way we are required to write the answer, and not this is the way you have to write the answer. I request all of you to make the calculation of the answer, of course by the first method, which is the correct one. Step number 5. Calculation of NPV. Try to calculate NPV on your own. Please start writing down answer along with me. NPV calculation, year 1 to year 4 and 5th year. The amount of the recurring cash flow is 32,200, and last year it is 32,200 plus 10,000. So it is 42,200. Discounting factor at the rate of 9%. First year factor is 917, second year it is 842, third year 772, fourth year 708. So 1 to 4 factor summation 917, 842, 772, 708, 3.239, and last year factor is 65 paise. So present value 32,200 into 3.239. So 1,04,295.8. 42,200 into 0.65, 27430. Based on this, we compute the present value of the cash inflow. 104,295.8 plus 27430. So 131,725.8. Amount of the investment that we already have mentioned in step number 1, that is 1,20,000. And based on that, so we can make the computation of the NPV. The amount of the NPV would be 11,725.8. This is the way NPV can be calculated. Second part of the question. Question says that say compute the PI. So write down answer. Please take down answer along with me. PI is equal to present value of the cash inflow upon investment. It is 131,725.8 divided by investment. It is 1,20,000. So 1.10. So we can take the decision like this, that NPV is positive, so the project should be accepted, or we may write the answer as PI is greater than 1, so the project should be accepted. Write an answer. Doctor is advised to purchase the machinery because NPV is positive, full stop, or we can say that PI exceeds 1. This is the way we can write the answer.